Something extraordinary just happened right now, and almost no one fully understands what it means yet. At a time when the world is becoming more unstable by the day, when geopolitical tensions are rising and the risk of conflict is dominating headlines, gold, humanity's oldest safe haven asset, should be surging. That has always been the pattern. War rises, uncertainty spreads, and gold follows. But this time, that pattern has just been broken. Instead of rallying, gold stalled. And in key moments, it dropped. And behind this unexpected move is a force powerful enough to override even war-driven fear: the Federal Reserve. In its latest policy direction, the Fed has taken an aggressive stance, tightening financial conditions, keeping interest rates elevated, and signaling that controlling inflation remains the top priority. Even in the face of global instability, this is not just a technical adjustment, it is a direct intervention into how capital flows across the world. Because gold does not exist in isolation, it competes with yield. And right now, the Fed is making yield more attractive than it has been in years. Bonds, savings instruments, and dollar-based assets are offering returns that pull capital away from gold, even as uncertainty rises. The result is a collision between two powerful forces: fear on one side, and monetary pressure on the other. And, for the first time in a long time, monetary pressure is winning. But that surface explanation hides something deeper. Because in moments like this, markets are not just reacting. They are revealing. Liquidity is tightening across the system. Large institutions are adjusting positions. Leverage is being reduced. And when that happens, even safe assets can be sold, not because they are weak, but because cash becomes more important than protection. This is where the signal becomes difficult to ignore. A falling or stagnant gold price during rising global tension does not suggest calm. It suggests stress. It suggests that beneath the surface, the system is being pulled in multiple directions at once. And historically, moments like this do not remain contained, they evolve. Because when the rules that have guided markets for decades begin to break down, it is rarely random. It is usually the beginning of something larger. If you want to understand what this moment could mean for global markets, for financial stability, and for your own future, subscribe now. Because what happens next may redefine how the system works. To understand how this moment became possible, it's necessary to step back and trace the financial conditions that have been building over the past decade. Following the global financial crisis, central banks, including the Federal Reserve, flooded the system with liquidity, keeping interest rates near zero and encouraging massive borrowing, investment, and asset growth. During that era, gold thrived, supported by fears of currency debasement and long-term inflation. But that environment has now reversed. As inflation surged in recent years, the Fed pivoted aggressively, raising interest rates at one of the fastest paces in modern history and signaling a commitment to keeping policy tight for longer than markets initially expected. This shift fundamentally changed the landscape. Suddenly, holding cash and bonds began to offer real returns again, creating direct competition for gold. At the same time, the US dollar strengthened significantly, adding additional pressure by making gold more expensive globally. Layered on top of this monetary shift is the rise in geopolitical tension. Conflicts, sanctions, and energy disruptions that would normally push investors toward gold. But instead of reinforcing each other, these forces are now colliding. Large institutions facing volatility across multiple markets are being forced to rebalance, often selling gold to cover losses or meet liquidity needs elsewhere. This creates a feedback loop. As prices stall or fall, momentum traders and algorithmic systems amplify the move, pushing gold further away from its traditional role. What emerges is a timeline defined not by a single event, but by a convergence. Years of easy money followed by sudden tightening, combined with rising global instability. And it is this convergence that explains why something that should not happen is happening now. The breakdown of how this unfolded reveals just how quickly traditional market behavior can reverse under pressure. It begins with the Federal Reserve signaling that interest rates will remain elevated. immediately strengthening the dollar and pulling global capital toward yield-based assets. At the same time, geopolitical tensions escalate, creating uncertainty that would normally drive investors into gold. But instead of flowing into safety, capital begins moving toward liquidity and return. Large institutional investors, already exposed to volatility in equities, bonds, and energy markets, start reducing risk across their portfolios, and that includes selling gold. From one perspective, this is a rational shift. Higher yields make alternatives more attractive, and a strong dollar naturally pressures commodities. But from another perspective, it exposes a deeper structural dynamic. Today's gold market is no longer driven primarily by physical demand or long-term holders. It is dominated by financial instruments, futures, ETFs, and algorithmic trading systems that respond to signals in real time. When these systems detect tightening liquidity, rising yields, or downward momentum, they act quickly and at scale. As selling pressure builds, key technical levels begin to break. Stop-loss orders are triggered. Momentum-driven algorithms accelerate the decline. What starts as a policy-driven adjustment turns into a cascade. Each wave of selling feeds the next, pushing prices further away from what traditional fundamentals would suggest. At the same time, leveraged positions are forced to unwind. Margin calls compel traders to liquidate holdings, adding another layer of pressure to the market. There are also competing interpretations of what this means. Some argue that the market is expressing confidence, that inflation will be controlled, that central banks remain in control, and that gold is simply adjusting to a new rate environment. Others see it differently, suggesting that forced selling and liquidity stress are distorting prices, masking underlying instability, rather than resolving it. The data reflects both views. There is clear evidence of rising yields and dollar strength influencing gold. But there are also signs of unusual volatility, rapid fund outflows, and heightened sensitivity to macro signals that point to deeper stress within the system, because in a market this complex, price is not just about value. It is about pressure, how much strain the system can trip Mel before something breaks. And right now, that pressure is building. What makes this situation strategically significant is not just the price movement in gold, but what it reveals about the shifting balance between monetary power and geopolitical risk. Gold has always served as a signal, a reflection of trust in the financial system. When confidence weakens, gold rises. But when gold fails to rise during global tension, it suggests that another force is dominating the equation. In this case, that force is monetary control. The Federal Reserve's ability to influence global liquidity gives it a level of power that extends far beyond domestic policy. By tightening financial conditions, it effectively pulls capital toward the dollar and away from alternative stores of value. This creates a gravitational effect across global markets. Even nations facing instability or conflict must operate within a system where dollar strength and interest rates dictate financial behavior. And in that system, gold is no longer the automatic refuge it once was. At the same time, the geographic and strategic landscape is shifting. Key regions experiencing conflict are also critical to energy supply, trade routes, and resource distribution. This means that financial decisions cannot be separated from geopolitical realities. A disruption in one area can influence currency flows, which then affect commodity pricing, which then feeds back into global policy decisions. Gold sits at the intersection of these forces, making its behavior a reflection of multiple layers of pressure. There is also an operational dimension to consider. Central banks themselves are adjusting strategies. Some continue to accumulate gold as a long-term hedge even as short-term prices fluctuate. Others are managing currency reserves more actively, balancing between stability and flexibility in an uncertain environment. This divergence highlights a key point. While markets may push prices in one direction, strategic actors may be positioning for something very different over the long term. From a military and geopolitical standpoint, the implications are subtle but important. Economic strength underpins strategic capability. The ability to finance defense, manage supply chains, and sustain operations depends on stable financial systems. If those systems come under stress, whether from tightening liquidity or shifting currency dynamics, the impact extends beyond markets into national security planning. Taken together, this transforms gold from a simple asset into a strategic indicator. Its movement, or lack of movement, during critical moments provides insight into how power is being exercised within the NII system. And right now, that signal is unusually clear. Monetary forces are outweighing traditional safe haven behavior, at least in the short term. And when that balance shifts, it rarely does so without consequences. According to leading financial analysts and policy experts, what the Federal Reserve has done is being interpreted as a deliberate prioritization of monetary stability over market comfort, even in the face of global instability. Intelligence-style assessments emphasize that controlling inflation is not just an economic objective, but a strategic one. Persistent inflation weakens currencies, erodes purchasing power, and ultimately undermines long-term financial credibility. From this perspective, the Fed's aggressive stance is not optional. It is necessary, even if it creates short-term distortions in markets like gold. Experts at major economic institutions point out that this creates a unique environment where traditional signals become less reliable. In previous cycles, gold rising during conflict was a clear indicator of fear. Now, analysts warn that liquidity conditions may be a more accurate gauge of stress. When liquidity tightens, assets across the board, including gold, can face downward pressure. Regardless of geopolitical conditions, this reframes how markets should be interpreted. Instead of asking why gold is not rising, the more important question becomes, where is the liquidity going? There is also growing attention on the role of global capital flows. As the Fed maintains higher interest rates, international capital is drawn into dollar-denominated assets, reinforcing the strength of the currency. This has a cascading effect on global markets, particularly in emerging economies, where capital outflows can create additional instability. In response, some central banks are adjusting their reserve strategies, diversifying holdings, increasing gold purchases at the sovereign level, and exploring alternative financial arrangements. These moves, while gradual, signal a recognition that the current system may be entering a period of transition. Military and geopolitical analysts add another dimension, noting that financial pressure can influence strategic decisions just as much as direct conflict. Nations facing economic strain may alter their policies, alliances, or resource strategies in response to shifting financial conditions. In this way, monetary policy becomes indirectly linked to geopolitical outcomes. At the same time, experts caution that the system remains highly interconnected and sensitive to shocks. A sudden shift, whether in policy, conflict escalation, or market sentiment, can quickly reverse trends. This means that current conditions should not be viewed as stable, but as part of a dynamic process still unfolding. What unites these perspectives is a clear understanding. The Fed's actions are not just influencing gold, they are reshaping how the entire system responds to risk, uncertainty, and power. And that shift is still in progress. But there is another perspective that challenges the idea that the Federal Reserve has fundamentally broken gold. Some analysts argue that what we are seeing is not a structural shift, but a temporary distortion, created by unusually tight monetary conditions. From this viewpoint, gold's behavior is not a failure, it is a delay. The impact of geopolitical risk, inflation, and long-term uncertainty has not disappeared. It is simply being suppressed by the overwhelming force of high interest rates and a strong dollar. Economists who support this view point out that cycles of monetary tightening have historically placed short-term pressure on gold before longer-term trends reassert themselves. In their analysis, the current environment is defined by timing, rather than transformation. As long as central banks maintain restrictive policies, yield-bearing assets will continue to attract capital. But once those policies begin to shift, whether due to slowing growth, financial stress, or changing inflation dynamics, the flow could reverse quickly. There is also the argument that gold's role as a strategic reserve asset remains intact, even if market prices appear weak. Central banks in multiple regions have continued to accumulate gold over time, not for short-term gains, but as a hedge against long-term currency risk and geopolitical uncertainty. This suggests a divergence between market behavior and institutional strategy. While traders react to interest rates and liquidity, sovereign actors may be positioning for a different horizon entirely. Diplomatic and geopolitical observers add that current tensions, while serious, have not yet reached a level that triggers full-scale financial panic. Markets are still functioning, trade continues, and major powers are managing escalation carefully. In such an environment, the urgency that typically drives gold higher may not fully materialize. At least not yet. This creates a scenario where risk exists, but has not crossed the threshold required to dominate market behavior. Critics of the more alarmist interpretation also emphasize the adaptability of financial systems. They argue that markets are adjusting to a new balance between inflation control and growth, and that gold is simply finding its place within that balance. Rather than signaling breakdown, its current behavior may reflect a recalibration. This alternative view does not dismiss the significance of the moment.